Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jason Bloom, Director of ETF Research at Invesco, to discuss new fixed income ETFs added to Invesco's BulletShares lineup. Jason, it's great to see you as always. Welcome back to Trade Talks.
Yeah, good to see you, Jill. Thank you.
You got it. And give us an overview about the BulletShares suite of ETFs.
Yeah, sure. So the BulletShares were really designed to simulate the experience of buying individual bonds and laddering them out into time and holding them to maturity. That can be a bit of a complex, arduous process at times for investors. So the beauty of the BulletShares is you get immediate diversification within each ETF. You have a hold to maturity profile. So each BulletShares ETF has a maturity date that aligns with the end of the calendar year on the name of the fund, right? And each BulletShares ETF holds bonds to maturity. So you get that hold to maturity experience, but you get the liquidity and the efficiency and the transparency, right? And the diversification of owning an ETF.
How are the new fixed income ETFs structured?
So as I mentioned, each ETF holds bonds with an effective maturity that aligns with the year and the name of the fund. So the 2024 BulletShares, for example, is going to hold bonds that either mature in 2024 or in some cases are priced to a call date in 2024. But regardless, as you go through time, you get into that final year, bonds begin to mature or are called away, and the portfolio slowly transitions to cash throughout the year. Or in the case of the munis, they slowly transitions to a tax-free money market muni exposure. And then we get to the usually around the second, third week of December, the fund terminates and distributes that NAV out to the shareholders with no action on their part.
That was my next question. What happens as BulletShares ETFs approach maturity? Does the ticker just go away and the cash gets transferred to the client account?
Yeah, it does. That's exactly what happens. So the idea here is it simulates a bond maturing. And of course, with the case of a bond, the par value comes back to the client. In the case of the ETF, the NAV comes back to the client.
Where do they fit in an investor portfolio?
Well, certainly the original client base were clients who historically had purchased individual bonds and just found this as a much more convenient, cost-effective way to accomplish the same goal. But we've also seen a lot of clients over the years that invested in traditional corporate bond mutual funds coming over, and if not replacing those mutual funds, at least complementing those mutual funds with a bond ladder that provides that visibility of buying a yield to maturity and holding to maturity and insulating themselves from interest rate risk, right, through that hold to maturity process.
And finally, Jason, what differentiates BulletShares from other fixed income offerings?
It's really that idea that the duration of the fund slowly rolls down to zero over the life of the fund, whereas most traditional fixed income mutual funds or ETFs, they have a duration target and it's perpetual. They're always subject to interest rate risk over time. And so with respect to any particular period of time, there's a lot of uncertainty as to what your total return is going to be. Whereas with the BulletShares, you can nail down the specific lifespan of the fund and know that I'm taking credit risk, but I've insulated myself from interest rate risk, and it provides a lot more visibility over any specific period of time as to what my total return is going to be.
All right, Jason, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.